You're listening to the Master Passive Income Podcast Network. Welcome to the Master Passive Income Show. My name's Dustin Heiner, and I'm here to help you get financial independence, quit that job, that just over broke job, by investing in real estate. And in today's show, super pumped to share with you two huge things that you need to worry about in your investing. Number one, it's keeping your money away from the tax man, because he will come always. Death and taxes are always going to get there, as well as protecting your assets from other people who want to take it from you. All right, let's start the show.
Welcome to the Master Passive Income Podcast, where we talk about investing in real estate with a special focus on making enough money so you can quit your job and live the dream life. And now, here is your host, Dustin Heiner.
Hey, super blessed as always to have you here with me on the show. Now, as I was doing that intro, I just realized that it might have sounded like I said not the best word. What I was saying was assets with the T, assets, like an asset that you hold. And so we're going to show you how you can protect your asset. Not the other word. I don't want to cuss on because this is a show we don't really cuss. But anyways, I thought that was just funny. I had to share with you that I got a kick out of that. So we are coming off of Income Building Live. It was absolutely insane and amazing how fantastic this was. And this was 5 years of doing Income Building Live. And this was by far the best one. We had so many of the people who've come in the past, investors, they came to Income Building Live and they were sitting in the chairs at Income Building Live watching and thinking, man, I wish I was investing already. I hope I can do it. And then a year, 2 years later, 3 years later, they're on the stage and they are telling their story to hopefully encourage you and obviously other people to invest in real estate. And so I will probably be releasing some of their talks on the podcast just so you can hear their stories. And remember, they're on the stage in front of hundreds of people. And so, if they're nervous or if they stumble or anything, which they did, and they did a great job, but, they're not public speakers. They're not, influencers or anything. They're just regular people that have found a way to change their life by investing in real estate. And today I am super pumped to bring on somebody who's actually helped lots and lots of people, investors, with their accounting and with legal stuff. And he talks about what he calls the trifecta. The trifecta to protect your assets, to keep it away from the IRS, from taxes coming out of your pocket. Well, he shows us how to do that. And it is amazing how he actually has this trifecta planned out. And honestly, you got to go watch this on YouTube. So on YouTube, I show he actually gets a whiteboard. It's a TV, but a whiteboard TV, and does a diagram with everything. So you can watch it on there. I'll put the link in the description for you to be able to go watch it on YouTube. But he maps it out, and he does an amazing job helping us to understand exactly how this trifecta works by having your LLC, by having your assets and everything in different buckets. You know what? I'm doing a horrible job, but let me bring on my guest who's going to actually explain it very, very well for you, because he's been doing this for very, very long time, years and years and years, coaching us, people like us, to do all this the right way. He has a fantastic YouTube channel, and he is a great guy as well. We hung out for just a little bit longer. I was on his show. He was on my show. It was fantastic. So let's not waste any more time, because I want you to learn from my amazing guest today. I have Mark Kohler on with me, and he's going to show us how we can do all this protecting our assets and keeping more of our money from the IRS. All right, here we go. Here's my interview with Mark Kohler. Mark, thank you so much for being on the show.
Oh, thanks for having me. Love what you do and love real estate. It's funny when you just said that. It's like when I came out of law school and an accountant and started meeting with clients, and, tax lawyers talk to wealthy clients. That's just what we do. And it blew me away so early in my career how many wealthy people owned rental real estate, accompanying their day job, their career, their businesses or whatever, and full-time real estate investors too. But it was like, it blew me away. 90% of my clients, just successful clients, own some form of rental real estate, period. So love what you do.
Fantastic. And that's how, when you own real estate, it's just amazing all the different ways it makes you money, saves you money, gets you out of taxes, all this sort of stuff. And, I know that you are really, really knowledgeable, being a CPA and like you have a firm and everything, doing all this sort of stuff. With somebody, usually when people are investing in real estate, they think of, okay, I got to get an LLC. I need to put it in the property in the LLC, but then they have issues with getting loans and things like that. Um, Out of all the people you worked with, is there a certain structure, entity structure that you would suggest as they're getting started?
Oh yeah, and we can have so much fun with this today. Wherever we go, there's just so much. If some of your listeners may have heard of me, if you're in the tax and legal space, you're going to bump into me if you do any googling at all. And I'm trying to be the nerd of the country in this area, the most popular nerd. But anyway, the phrase that many of you have probably heard of me talk about is the trifecta. Trademark use only allowed by Mark J. Kohler. No, I'm just screwing around.
You said trifecta.
The trifecta. The trifecta is how I help all my clients organize their business, tax, legal life, and it's there to provide asset protections, tax savings. So that's the structure, and I can describe it verbally, or if you want me to jump on the whiteboard. But this is that's the way to do it. The trifecta.
Are you into horse racing?
Say again.
Are you into horse racing?
No, not particularly.
Okay, just the trifecta is just the word that my dad would take me to the horse racing track, and if he said trifecta, I was like, oh, that literally went to you're betting you get a trifecta. But that sounds awesome. I personally never heard of it. So, what is the trifecta? Like, can you walk us through what that is?
Oh, you're gonna love it. And I've got 2 cameras here. So for your YouTube audience, and if you're listening to this on your podcast app, you're gonna want to catch it over on YouTube. And I know Dustin has the links going back and forth. But let's jump over to the whiteboard and let me just show you this real quick. What I think will just blow your mind and how this looks. Can you see me all right? I'm a little dark, but
sure can. No, you look fine. And the screen is going to be easy to see.
Okay. So here we go. Here's the trifecta. And I'm going to make this a little bigger. There we go. So the trifecta starts with the foundation that's going to be typically, I'm going to make this even bigger. I want to get this dark. There we go. The trifecta is going to start with the foundation that typically is your revocable living trust. Now, this is also where all your money goes down into your 1040 tax return. So think of it that way. Then we're going to split your life in half, and we're going to put your operations over here. We're going to put your assets over here. Now, for any of you that have a day job, many people have a W-2. I serve on a board of directors of a large corporation. I get a W-2 from there. So I'm going to have a W-2 over here on the side, and that's going to bop into my 1040. But there's no real tax planning I can do with the W-2. I'm hosed. Bend over, not pretty. Okay, so the IRS loves W-2s. But if I have an operational business and 40 million Americans now have a side hustle, you get a 1099 from anywhere, you have a side hustle. So that's going to be typically a sole proprietorship or a single member LLC. But what you find out real quick is LLCs don't save taxes. It's don't. LLCs are for protection and organization and partnerships. But that LLC is going to graduate into an S corporation when the time's right. So this is our operational side. And this is it. I'll be done in 2 seconds. The right side is where we put our assets. And I'll divide this up a little further later maybe. But just think of this as an LLC. And there's my rental. So I have a rental property for my LLC owned by my trust. I have an S corporation for my business. Your podcast is your S corp, I'm sure. And then your S corp is owned by your revocable living trust. Trifecta. This is the realtor. This is their rental property. This is the dentist. This is their building. This is the influencer YouTube podcaster. This is their duplex. And then it all is owned by your revocable living trust, and all the income, K1s or your Schedule C or your 1120S, everything flows down into your 1040. And then we take another bite at the apple with write-offs. And so as we start tax planning, we're tax planning on both sides, and we have a firewall for asset protection. Assets over here, operations over here. That is the trifecta. So it just brings it all together.
So would you have, or have you, I know you've heard of it, but I've heard of other people, and not very many other people like on, let's say, YouTube or wherever, that talk about asset protection as well as anything when it comes to properties, a real estate privacy trust. Have you heard of one of those?
Yeah.
What? Tell me, is that a bad thing to have a real estate? I just heard about it.
No, it's just funny. A real estate privacy trust is somebody in a corner of the basement somewhere said, let's call a real estate privacy trust. And, let's call it an asset protection double down MX 1000 trust. It's all bullshit. It all means the same thing. It's a revocable trust, a land trust, where I can hide the potential owner and appoint a designated straw man trustee to create a little more privacy. I love privacy. I wrote a book on privacy, but it does not give me asset protection. Think of it like a bulletproof vest compared to a camouflage jacket. Now, if I'm going into combat, I want both. I want camouflage and a vest. But if someone's got a powerful enough scope and they know how to look through a trust, camouflage is done. Where's my vest? And so I'm not opposed to land trusts. Set up many of them in my career. I don't even own one myself because I think they're worthless, but that's me. So I'm going to be using LLCs and other structures to provide privacy and hide my assets. But I would remind everybody, there's a difference between privacy and protection. Because anybody that's pissed off enough with enough money, they'll find you. They will.
Well, especially with AI nowadays. I mean, it seems like we're going to have worse and worse case where anybody's just going to be able to look up anything, especially lawyers who want to take away money from people. Like when they take on a case and they say, well, I could find 8 properties and there's a lot of assets a lot of equity we can go after, or if they can't find anything like the privacy. But you're right with the protection as well. I mean, I also find that having a really good insurance per property, that's going to be one of your number one things. What are your thoughts when it comes to insurance?
Yeah, and Dustin, I like what you just said there too. I'm not opposed. I have privacy structures where if you get mad at me and you want to sue me, I text and drive, I run over one of your kids, whatever it is, and you're going to sue me in a bad deal, you're going to do an asset search right out of the gate. What does Mark have? What can we go after? Now, the more privacy I have, the less you're going to see on that first take. And so all of us want to have a pretty small footprint in public record. And AI only can look at public records. So we want to keep our public record ownership to a minimum. But if you go ahead and file that lawsuit anyway, there's this word called discovery and contempt of court and trying to hide assets and fraudulent transfers. That's when the judge gets really mad at me and you win. So there's a point where privacy did its job and then it's gone. So I wanted to clarify that because I like what you're saying and I do have privacy, but we just can't think of it as the get all end all. It's a part of the strategy. It's a part. Insurance is a part. You brought it up. I love it. Now, some people go, yeah, well, I live in California, so an LLC is $800 a year. So I'm just going to buy this umbrella policy that's only $400. Yeah, do you know why it's only $400? Because it pays out about 0.0001% of the time. You think the insurance company is going to give you that good of a deal and now you don't have to do asset protection? Bullshit. But I'm going to have that insurance policy because I got kids that drive. I don't want an uninsured motorist hitting me. There's reasons for an umbrella policy, and I'm always going to have owners, property casualty, of course. But I don't want to just, again, make that my only layer of defense. I want to have my insurance, my privacy, my LLC. I need to be doing my minutes for my LLC. I need to have a good corporate book. I need to have title in the name of the LLC. We can get back to this mortgage thing. That's a myth. And so we want to make sure that everything's structured properly so I have multiple layers to protect me and give me better tax strategy.
So would you have per property one LLC or bundle some properties in one LLC? Like how would that work out?
Oh, I like your question. I agree. I love bundling. You can save on your insurance that way too. I don't know if you knew that. There's a certain insurance company that was a joke. Dustin,
you can't save money insurance.
There's bundling my insurance. Anyway, okay. So I was saying, it's overkill to have an LLC for every rental property. Now, I own a law firm, have one for 25 years. I got a team of lawyers. We have clients all over the country. We're affordable. Though I won't even do that to you. And I'm a dirty, not the dirty, rotten scoundrel attorney, but we don't want an LLC for every rental because it's overkill. But I don't want to put 20 properties in one LLC either. And so it comes down to quality, not quantity. Now, if I've got an Airbnb golf course rental worth 1.2 mil, I'm not going to put my 3 meth lab rentals in the same LLC. I'm going to have an LLC for those that are cash flow, low income housing rentals. And then I'm going to have an LLC over here for that property. If I have a commercial property, it will deserve its own LLC. So we want to just be nimble and not overdo it. There's so many scam artists out there. There's bozos out there selling, you need a crypto LLC, you need a special Wyoming LLC, you need this because they can sell it. Doesn't mean we need to buy it.
That's I totally appreciate that, especially when I know that lawyers can only go after the equity. Like if you have a loan on the property, they can't take out the loan, like because there's somebody else still owns that, so they only go after equity. So what I personally like to do is per LLC, I only put in the amount of properties that I'm willing. If it happens, I'm okay if it lets go. So like, maybe $500,000-$600,000, maybe $1 million per LLC in equity that I'd be willing to give up. For me, it's just like 500,000. I have in equity, say 5 properties, and I have that much equity in them total, and I'm willing to have that in one LLC. That's how I like to do it, just because I don't want to have lots and lots of headache. Because I have 30 plus properties and apartment complexes and stuff. It's like that's a lot of work for all that. But what are your thoughts about that? It's just like bemuddling, or in your mind thinking,
No,
I'm okay with this one LLC to have that much equity in
and
it.
let's go to the whiteboard on that. Yeah. And let's go to the whiteboard on that, because that's a great point. Because if I've got my LLC here, all right, let me move this out of the way. Grab the wrong pen. If I've take my trust and I've got 3 rental properties and 2 of them have 200 grand of equity, I could put those same in the same LLC and bundle those. One LLC, we're clean. This LLC over here has 500 grand of equity with 1 rental property. Okay, we're going to keep those separate. And we're going to have title to the property in the name of the LLC and title to, and then ownership in the membership interest in the name of the trust. And we also are going to use manager managed LLCs. We don't set up LLCs that are member managed, because then I have to tell the world who the member is. So we're going to keep that private. Some of you may have gone to LegalZoom and done it wrong. We have 2 paralegals full time that just clean up entities people set up online, and a service for that to keep it affordable. But anyway, so the reason why I like this is you've got your eggs in different baskets. And what you just brought up, insurance. What is the typical perfect deductible for property and casualty? 500 grand. So I'm going to have a 500 grand property and casualty insurance policy here and a 500 grand here. So now I'm saving insurance premiums with a $500,000 claim limit, but I know that on top of that, I've got my LLC. And then what I do is I put an umbrella over the whole damn thing for $1 million. And that may cost me $300-$400 a year, but that's an extra layer. And so now, look at this. There's my umbrella over the top, a more affordable insurance policy. I've got my 2 property and casualties. I kept my equity to $500K. We typically say $400 to $500K. It was funny you said that, Dustin. Our lawyers, that's what we recommend. And then you've got a wall between the 2, and it all flows down into your trust. Your trust also owns your home. We've got insurance policies, life insurance, blah, 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 investment accounts. I haven't even got your IRAs and 401ks. But this is a typical structure, and you're being efficient, you're getting the right insurance, and you're not overdoing it with LLC.
So talk to me about because you had a good foundation of the revocable living trust. How does somebody that doesn't have one, not just create it, because we'd have, people like you, or, companies that would actually be smart, know how to do it, create it, but like practically, how do you get a bank account in the trust name? Do you have all the documents signed on the trust? Like how do you practically use a revocable living trust?
Oh, you bet. And I'm going to say this for 20 seconds in advance so everybody's on the same page. A revocable living trust is part of an estate plan. An estate plan will include a will, powers of attorney, pull the plug if I'm a vegetable, living trust, memorandums, blah, blah, blah. And it's an estate plan package. Most law firms are going to be between $2,500 and $3,500 to nail those. And we do them all across the country. So you're going to get an estate plan. Once you get it done and designed. Now, and by the way, I want to say this to everybody out there. I don't care if you're 20 years old or 80 years old, have kids, no kids, married, divorced, no married. If you own real estate, you got to have a trust, because you avoid probate and having to go through court. You may have a will that's been notarized 3 times and witnessed 9 times. Doesn't matter. It's going to go through probate. The trust keeps out of public record, gives privacy, and avoids all of the legal fees after you're gone, so you can protect what you built and pass it on to the people you love or the organizations, if charities, whatever. So you get your trust set up, but if you don't put anything in it, it's worthless. So it's called funding the trust on day 2. So you set up your trust. It's revocable, change it anytime you want. There's no tax return for it. There's no tax effect. But now I got to start putting stuff into it. And there's 4 main assets I want in the trust. And this answers your question. The first one, this is the most common, is you're going to put your home in it. So if you own a home, you're going to transfer the trust. This is your personal residence. And there's not going to be a due on sale clause at the bank. They don't care. You're still on the loan, and you're going to transfer the property into your trust. There's 3,500 counties around this country, and we have 2 paralegals on that department that just do deeds every day, just transferring deeds and titles to get everything funded. Then you're going to put your life insurance to make sure any money goes into your trust, so that you don't want your life insurance going to a 12-year-old. You want it to divvy out over time, and that's what the trust would do. Or if you have a brother or sister that's in rehab, whatever, you want your money to go to the trust, then out with rules. Then we're going to have your financial piece. So this is all on the asset side again, because over here you have nothing. My S Corp owns a laptop. Sue me, you can have a laptop. Don't care. But over here, we're going to put your IRAs, your 401ks, your investment accounts, gold, silver, crypto, your wallets, everything is going to come down into the trust. So we got 1, 2, financial 3, and then number 4 are your real estate holdings. And the trust owns the LLC. Okay, so how do we do this? Well, once you set up your trust, you're going to deed through a grant deed in California, a typical warranty deed in almost every other state. We transfer the home into the trust. When you form an LLC, we make your trust the member. If you already have an LLC and no trust, when we form the trust, we do what's called a change of beneficiary form in a membership transfer agreement. So it's a membership transfer agreement that's going to transfer the LLC ownership. The change of beneficiary form is on the life insurance, and the change of beneficiary form is over on the IRAs or 401ks. So if anything happens to you, the beneficiary is the trust. The owner is the trust. A lot of times you can do this stuff yourself. We have paralegals that'll help, but it's very affordable. And so the next time, Dustin, you form a new LLC and you call me up and you're like, hey, Mark, I'm forming an LLC in Alabama. I just got a fourplex over there. I love it. Oh, okay. We're going to set up your Alabama LLC. And then the member is going to be the trust. So right out of the gate, your trust is the owner. We don't have to clean it up later. Some of you may already have a trust, but your LLCs are not the owner. So we got to make sure everything's communicating properly. So if anything happens to you, it all rolls the right way.
That's fantastic. I know. So when my dad passed away, I set up a trust for him a long time ago. I don't know, 10 years ago. And then when he passed away, it was so much more of a relief knowing that we didn't have to worry about any probate. We didn't have to worry about changing deeds and all that sort of stuff. It was in the trust. Beneficiaries, everything worked out really, really well. So I wholeheartedly agree. If you don't have a trust, you should look into getting one. You should just get one. That's really what it comes down to. And at any time in your life, like you said, if you're younger, get it started now. But then you could always adjust it. You could always change it. You can make a new one if you not want. But in the end, if you have any real estate, if you have any assets whatsoever, it's so smart. You're going to help your kids and grandkids in future headaches at all, removing all of those.
Yeah. No, I'm with you. And so we recommend that everyone have a trust. And then you get divorced, you do a new one. You get married, you amend the trust. And so it evolves and it grows with you. You have more children. You might want to modify it a little bit. It'll also capture any new children. And kids get older. And I like sending money out in stages. Kids get money at 25, 30, 35. Money for college, this, that, and another. Help them start a business, buy real estate. But anyway, but that's the trifecta. The estate plan is at the bottom. The asset protection's on the right, tax planning's on the left. Now we're going to get some tax benefits from investing in real estate, but not everybody does immediately. Sometimes it's long-term delayed gratification. I'm going to get that delayed benefit down the road. I might do a 1031 exchange, do a charitable remainder trust. I may not get 100% bonus. I'm not a real estate professional. Oh, but I'm going to use the short-term rental loophole, or I'm going to use the self-rental loophole, and all the little loopholes out there to get better write-offs if you're real estate. You want to be attuned to that because you're your best captain. You can't depend on your tax lawyer to call you up every week and go, oh, I was in the middle of the night thinking about your case. No, you got to pay me to do that. So you got to be your best client yourself. And that's why, I don't know, some people think, oh, Mark, to listen to your podcast, I don't want to listen to tax and legal. Oh my gosh, we keep it fun, first of all, and tell crazy stories. But if you don't do it, no one else is.
And I want to pause for a quick second and share that, honestly, I really want you to invest in real estate. Now, my new goal is to help 1 million people invest in real estate. So 2 things I would ask from you. Number 1, if you get anything out of this episode, please share it with somebody else. Just say, hey, check out Dustin and Master Passive Income. He really wants to help 1 million people to invest in real estate. That's number 1. Number 2, I want to get you to invest in real estate. Get my real estate investing course absolutely for free. Text the word rental, RENTAL, to 33777. Rental to 33777. I'll literally give you my course, show you how to find an area of the country to invest, how to build the business first. I always talk about that, and how to find the right properties, how to make sure you're getting experts to do the work for you, and scale the business to where you're making $250 or more in passive income. Scale it to quit your job. I'll literally get to you, or go to masterpassiveincome.com/free course. Obviously, it'll be in the description, but I really, really want you to invest in real estate, because the more that actual, normal, everyday people own real estate that are good landlords, the better everybody's life gets. So give me some more loopholes. Okay, so we got, you mentioned a couple, which I could quickly walk to. The short-term rental, quote-unquote, loophole. They call it loopholes, but they're not loopholes. It's just the way the law works. And so what actually happens is if you have active income, you can actually write off your short-term property, your losses from your short-term property, get your active income, which is great because it's a short-term by the IRS sees that income as active income, which is great. Am I explaining that right?
No, but that's okay. Let me straighten out a couple of things there because you're close on a couple of points. First, the reason why it's called a loophole, and I'm okay with that. There's nothing wrong with that. When the rental property real estate tax professionals code sections were passed, Airbnbs didn't even exist. 10 years ago, I didn't even use an Airbnb. No one did. The IRS and the Congress has not caught up to the rules for short-term rentals fall in a hotel. Because the rules have not been modified to grab a short-term rental and make it treated like a long-term rental. So we're in the space where an Airbnb is taxed like a hotel if you do it right. And so that's why it's called a loophole. So everybody, don't freak out. If it's there, take advantage of it. It will close at some point, like all good write-offs do. A government doesn't want to give away money. So anyway, that's point number 1. But if we're over here, and I'll go to the whiteboard, if we're over here on our trifecta, and I'm going to have a long-term rental, okay, LTR, long-term rental, LLC, and sign my typical mortgage, lease agreement, this long-term rental. If I'm not a real estate professional, any losses go into a carry forward bucket called a PAL, passive loss carry forward. Love it. I carry my losses forward. When you go to sell any of your long-term rentals, you can dump that bucket out. It can go to any of the rentals. So some people go, yeah, Mark, I'm not a real estate professional, so I don't take the write-offs. I'm like, no, take them. You'll get them someday. This is a warm blanket. Let's fill up that bucket. Now, the short-term rental, it's still on the right side. It is still passive income. It is not active income. It's not. But the reason we can get around this rule is, to be a real estate professional and take the depreciation on a long-term rental, you've got to meet 3 tests. You've got to meet it's my primary occupation to be in real estate. I spent 750 hours a year doing real estate, and then I can show material participation in working on these rentals. I got to meet all 3, or I don't unlock those losses. With a short-term rental, the beauty is because it's not considered long-term real estate, but like a bed and breakfast type of thing. I don't have to qualify as a real estate professional. All I have to do is qualify for material participation. So I only have 1 test, not 3. And so if I'm a lawyer or I'm a doctor or an online personality like you, and you go, hey, I'm going to go buy a short-term rental. I'm not a real estate professional. That's not my full-time gig. I'm over here as an influencer. That's my full-time gig. So I'm going to go over here and buy a short-term rental. I have one of 7 tests to meet. And if I meet one of those 7 tests, I unlock the losses. They don't go into the PAL. They come right over here against my W-2 and any other income. The most common is test number 3 that says if I put in 100 hours, and if I'm married, that's 50 hours each, husband and wife, and we put in 100 hours and on this property, fixing it up, staging it, furniture, closing, bookkeeping, working on this rental in the year, all in the same year, and it's 100 hours more than anyone else. Contractors, property managers, they can't put in more time than me. My wife and I, we have to put in 100 hours. If I reach that, I can go depreciate the hell out of this, do a cost seg, suck out all the depreciation and write this off. Year 2, I don't care because I've already sucked out the write-offs. So then I kick it out to a property management company, walk away from the material participation, put it on autopilot, I'm off to the races. So it never converts to active income. It's still passive. It's not subject to self-employment tax. I'm not going to put it in an S Corp ever. Don't let your S Corp manage it. Don't let your C Corp manage it. Stay away from the left side. Just leave it over here.
So it's the depreciation, the accelerated depreciation that you're going to be able to use as a loss.
Yeah, in the year one. So that bonus,
Got it.
Sorry, I get long-winded here, but that bonus depreciation is what you're unlocking in year 1. My wife and I just finished our 4th Airbnb, and we bought it in October, worked on it in November and the first week of December, rented it 3 times so we could have an average rental. And we put in our 100 hours. We were kept a little log going to Home Depot, working on everything, and knocked out it. And I'm a tax lawyer. She's a life coach. But we just unlocked, I could bring you some numbers if you want, but like at least 300 to 400 grand in write-offs. And I can use that against other income. It's crazy.
Oh, it's great. What other loopholes are you thinking of? I mean, there are plenty of them, but what other ones that you could quickly think off the top of your head like this?
Oh, well, okay. I'll give you 4. And because I don't even know if I want to, I'll say 4. So here's your trifecta again. See, once you understand the trifecta, everybody watching, you're like, oh, I get this. Over here is my S Corp. If I'm a real estate professional, I'm going to save on self-employment tax. So I need to run all of my commissions, my 1099, my fix and flips, my rehabs, my wholesales. Everything's got to go through an S Corp. And an LLC, you're still paying tax out the butt. So you got to take your LLC and convert it to an S Corp.
Classification,
tip number 1. Tip number 2, I'm going to come over here, is long-term rental. So if I have a long-term rental, I'm going to put my properties in an LLCs or how many LLCs. We already talked about that. And if I can, I'm going to unlock them through rep status, real estate professional status. If I don't, I'm still going to carry those losses forward, and I might use a 1031 exchange down the road or dump out those losses anytime I sell. But they stay in their own quadrant because they're long-term. Up here, I've got my short-term rental group. I may have 1, 2, 3, or 4 rentals up here that are all short-term. How many LLCs do I need? Who knows? Again, asset protection is different than tax planning. So we want to find a good balance there. And then the next strategy that I'll put is number 4. So that's number 1 is the S Corp. Number 2, long-term. Number 3, short-term. Number 4, and I love this, is the self-rental. This is -9. This is -4. So it's 469 AF7 -9 -4 in the IRS code. Us tax lawyers geek out on that, but you real estate pros know this. This is where you form an LLC and rent your building back to your business. And when you have common ownership, when you own 100% or 60%, whatever the percentage is here and here, they have to match. So if I'm a optometrist and I want to go build my own building, or I'm a architect or whatever, and I want to rent my condo, I'm going to go buy a commercial condo, rent it back to my S corporation, which is awesome because I'm going to be moving active income over to passive income. I get asset protection for the building. When you go see a restaurant, the restaurant doesn't own the building ever. The restaurant is here. The building is here. So we've got restaurant building, a restaurant operation. So then once you have common ownership under Dash 4, a self-rental, I don't have to be a real estate professional, and I don't even have to have material participation. All 3 rules that I have to have here and the 1 rule I need to have here, nothing. I just unlocked all the depreciation. So
how is that though? How does that?
You're your best renter.
Yeah. Right? How does that unlock depreciation?
How does that what?
Unlock the depreciation.
Well, okay, let's use an example here. Well, how does it lock it? Or show you some numbers, but
but what you were saying was you don't have to have the material participation, 750 hours, all that sort of stuff. How does that? How come you don't have to have that?
Because what you do is you make a Dash 4 election. This is not even.
Oh, it's a Dash 4 election. Okay.
Yeah, and what it says, and this is the rule in the IRS, is you're treating the rental and your business as one economic unit. And because it's one economic unit, the losses here can wipe out the income here.
Now I get it. Yeah.
Again, when you make the Dash 4, you're like, I'm not a real estate investor. I'm a business owner that needs a freaking building. So you unlock it.
That makes a lot of sense.
For those out there, like, what's the big deal? Can I show a couple numbers here?
Please, yeah, absolutely.
So let's say you buy a building, and here it is. And it could be commercial, whatever. We'll use some round numbers here. I'm just going to riff here. So let's say it's $800,000. There's your purchase price. I don't care about the mortgage. 10% down, 0 down. Don't give a crap. Here's your purchase price, $800K. Now you have to take out the land value, typically around 20%. So I'm going to take $160,000. That's 20% of 800, and that's going to be the land. So that means the building itself is $640,000. Okay, so there's my basis in the building. I got $640K. Now you say, I'm going to go do a cost segregation study, which I'm sure you've talked about here on your show over and over again, right? So I go pay for a cost seg, may be $2,000 to $4,000, depending on whatever. There's a lot of talk. I do whole shows on cost seg. But let's say you have their cost seg is typically going to say what you're doing, people, when you do a cost seg is saying how much of this building is not going to last 39 years or 27 and a half years. Because a short-term rental is 39, a long-term rental is 27 and a half years. Commercial is 39 years. So what's going to last less than that in, let's say, 15 or less years? So how much of it is 15, 7, 5, or 3-year property? Because under the One Big Beautiful Bill, anything that's 15, 7, 5, or 3 is going to fall apart. I have to replace it within those years. I can take 100% bonus. I can write off all of that now rather than wait for later. So with a cost seg, typically you're going to see about a 40% allocation, 40% of 640,000. So that's going to be about 250K is going to be 40%. Yeah, half would be 320. So at about 40%, or is it about 360. We'll put 250 just here to be safe. So $250,000 is considered chattels. And that's the term in the IRS that says I can now write this off 100% under bonus depreciation. So I can write off $250,000 plus the furnishings to get the property up and going if it's an Airbnb. And so buying this rental property, I might put down 5%. I mean, I could put down a $40,000 deposit, get a mortgage of $760. The sucker's cash flowing. I'm a happy camper, but I put down $40,000 and I get a write-off of $250,000.
Totally worth it.
It's awesome. And I'm cash flowing to boot. That's the theory.
Man, this is great. Is there anything else in the tax idea? Because there's obviously tax planning. Somebody, if they're going to be realizing that they want to save some money, they definitely need to talk to somebody like you, talk to your company and work with you to actually plan that out. Because you don't wait until after the year's over and then you go talk to your accountant when you got to file taxes. Well, how do I save taxes? Well, you should have done it a year ago. You should have talked to me a year ago. So gotta be talking beforehand. But is there anything else like off the tip of your mind that you could think of that would be really good for somebody to be watching out for?
Yeah, it's kind of like saying, is there anything else you do to lose weight? Yeah, when you got all day, tomorrow next day. And this is why I have a podcast with over 1,000 episodes over the last 17 years. I was podcasting before it even was a thing. So people, any topic I've taught it 5 times on my podcast and would love you to check that out. We'll give you a link here sometime. And I want to comment on this too. You made a very, very important point. Right now, I can't do anything for last year. Rarely can I pull a rabbit out of my hat for last year. April 15th, I'm golfing. 60 to 70% of our clients extend their tax returns. I'm not rushed to file on April 15th. What's the big freaking hurry? I send in a deposit what I think I owe. Then I get to work on my tax planning or tax filing and look at my tax planning for this year when I'm not stressed, when I can do better bookkeeping. What's the hurry, people? Freaking A. The busy time is October, because October 15th is when that's when the buzzer goes off. That's for the deadline. And so I always file my tax return the last one in the door. The later you file, the less chance of an audit. The IRS is going after all the cows that went through the gate already. You're just going to stroll in at the last minute. They're already too busy. And stats show that every year. And so when is our busiest time of the year for planning? November and December. We literally have a policy at our law firm and our accounting firm network and everything that you don't take time off in November and December just for the major holiday. You're vacationing in January and February, because anybody that's doing tax planning, it's a year end. My phone's ringing off the hook.
Well, I always call my accountant towards October, November. I'm calling my accountant. Hey, this is how much I made this year. What should we do right now so I don't pay a lot of taxes?
Yeah, it's critical. And so anyway, to your point, you want to start now, people, getting your structure, we have like a comprehensive tax consult that's like $1,750 around that. You meet with a real tax lawyer on Zoom and talk to people. I'm not here to do a infomercial, but I want you to know it can be very, very affordable. If we don't save you $2,000 in tax, we screwed up. I want to save you 10x that when you make a call with us and you got a real tax lawyer planning your small business life. We're hard to find. Most tax lawyers are working in Wall Street, Chicago, LA, New York. We specialized in small business the whole time, and that's been my passion and dream. But so when you say, what else can you do? Oh my gosh, I'll just rattle off a few. You should be holding board meetings for every one of your LLCs every year for good asset protection. Your family should be on your board of directors, your best friend, your mom, your dad, your brother, sister, whoever you hang out with. Every one of your trips should be a tax write-off. Thanksgiving is a corporate board meeting. Everything's paid for by the company. We're there to have a corporate board meeting, and we do. And it's extremely bonding for our family to get together and have the kids and family report. And we show our trifecta to our kids. What are we doing this year? What's our plans? We were talking about our Airbnb, and everybody's like, gosh, Mom, Dad, how do you find the time for this? We're freaking going hard. We don't watch Netflix all night, So your kids should be on payroll. And when I say payroll, that doesn't mean a W-2. And it could not mean a 1099. If you have kids under age 18, there's a special loophole for that. No withholdings, no SUDU, no FICA, no W-2 issued, no 1099. With kids over age 18, we have a whole other strategy. Is your spouse on payroll? Maybe he or she should be. Maybe they shouldn't. Don't worry about Social Security. We have the spousal benefit. So what's our 401k strategy? Do we put money in the 401k this year? Do we do our health savings account? I own rental properties in my health savings account and my Roth IRA.
Wait, hold on. You said in your health savings account owns real estate? How does that work out? I've never heard that. That sounds awesome.
Yeah, I have cows in my other HSA because I love Yellowstone and John Dutton. But I'll just diagram this one. That's a fun one for everybody out there. Is the health savings account is the best kept secret in saving for your medical expenses and getting a tax write-off. At any income level, there's no phase out. You can have an HSA, health savings account, contribute to it this year, take a tax write-off of over $8,000 on the front page of your tax return, pull it right back out for any medical expense you want. You don't have to wait till you're 59 and a half. It grows tax-free, comes out tax-free, and you get a tax write. It's like a Roth IRA on steroids. They're insane. I love the health savings account. I have chapters in my books on this. Donald Trump talked about it in his inaugural address. Both times he was in office, he brought up the HSA in his inaugural. And it's so, so important. But anyway, so you have your trust. You may have an IRA, blah, blah, blah. Let's say you have your IRA over here. You have a 401k. You got the day job 401k. You got the solo 401k. We want to be building all these tax-free buckets. My Roth IRA owns a lot of crypto, which I'm not going to pay tax on. And, but then my health savings account, I started it over 12 years ago. And once you have your HSA, it can form its own LLC. I have an LLC. If you guys want to go to I do not care if you go look on the Illinois Secretary of State website, you're going to see Kohler Holdings. It's an LLC owned by my HSA. I sometimes show pictures of it in my workshop. It's the cutest little meth lab, Dustin. It's adorable. Guys are great. Anyway, so this LLC owns a low-income housing project. I've started my HSA with $6,000. I bought a property for $40,000 with 10% down, seller carried back mortgage. And so for $6,000, I bought this little rental that cash flows about $200 a month. I've owned it over 9 years. It's paid for my kids' braces, pays for medical, tax-free. So I've got rental income going back into my HSA that pays for all my medical tax-free. My other LLC with my HSA owns a ranch in Utah, the cattle, not the ranch, that'd be over the top. But we have 24 head of cattle in Kohler, Brick Cattle Company, and that's owned by the HSA. My wife owns a portion of that, and I own a portion of it. Anyway, that's another strategy. So I have a crypto mine in my LLC, own rentals. So self-directing is such a huge strategy for real estate investors. I want you buying a rental every year in your own name and buying a rental in your 401k and IRA every year. Both places.
But I think, yeah, absolutely. And I never thought of using HSA, but that's fantastic because you're funding it through the real estate. That's awesome, man. Mark, you give us so much great insights. This has been great. Now, I definitely want people to come check out your podcast, but at the same time, how can people find you? How can they reach out to you if you wanted to?
Sure, you bet. And I'll say this humbly too. Some of you are like, "Holy crap, that was too much," or "This guy's got to be a scam artist. That's too good to be true," or whatever. Guys, I have these plaques on my wall for a reason sometimes to let people know I'm a licensed attorney in multiple states, a CPA in multiple states, served on the board of the AICPA. I worked at KPMG, one of the big five. I worked for the tax court. We've got a law firm. We're 25 years old. We've got a trust company. I train a network of accountants all over the country because I walked away from our accounting firm that had a waiting list of 3 years because people were like, "I need a good accountant." I said, "Screw it." I walked away from my accounting firm. We now have over 1,000 CPAs and enrolled agents around the country that are Main Street tax professionals, trained under 12 modules, 900 quiz questions of Mark Kohler. I'm trying to create an army of Main Street tax pros that you guys can use. And you go to mainstreetpros.com, go to the Tax Pro Network, interview, hire. I don't make any money off it. You hire your own accountant, but they got to pay me to be trained and certified and on that network. But so anyway, my podcast is the Main Street Business Podcast. The law firm is KKOS Lawyers. So Main Street Business Podcast. And where I was going with that at the beginning is I just start learning the basics. It doesn't need to be overwhelming. I try to keep it simple. I was brain dumping a lot here because Dustin, I know you wanted a lot of value for your listeners, but every one of those topics we could talk about for an hour and really unpack it. That's what I do on my podcast. I have 2 podcasts, the Directed IRA podcast and the Main Street Business Podcast. And I've got 4 books right here. You see some behind me. Get on Amazon. I got over 600,000 subscribers on YouTube. So go check it out, people. We're real. We're legit. Not crazy.
I love it too. And I personally, I don't want to learn any of this stuff. Like I know a little bit of it, like, got some ideas on how things could work, but I just much rather pay smart people who've done it before, who know how to do it. Much rather pay them because I save money, I make money because they're working hard, they're doing a great job. And I like what you said. If you can't make your clients money or save them that much money, I was like, yeah, you should be able to, because most people don't even know how to do it right, and they're going to screw it up if they're going to try to do it themselves. So get the right people. But Mark, it's been great meeting you. So glad. I'm glad to be on your podcast as well. So everybody, come check out his podcast, and you definitely need to be figuring out this stuff because you don't want to give your money to the government. They know how to spend it, give it to other people.
Yeah. Yeah, or give it away in some lawsuit, all the above, or give it away to lawyers when you die and your kids get nothing.
Absolutely.
So many ways to protect what you're doing. And I liked what you said, Dustin, there too, is that people, you don't need to know how to do these strategies, but you have to learn about them. and why you're doing it and captain your ship. No one else will. You don't have enough time or money to pay someone to captain your own ship. So you've got to know these strategies. I don't want to learn. I'll just pay someone. Great. Start writing me a check of $1,000 a day because it's good. But you learn what the strategies are, but then hire someone to implement them. Have a meeting twice a year, get a tune-up, boom, you're making money. If you want God to bless you, people, if you want the universe, the divine to bless you, you got to be ready to receive it. You got to be organized. Have you ever heard, you can't put new wine in old bottles because the bottle will break. And so if you want a structure, if you have a structure that can receive, then you can be blessed. And so get organized. And it does something to your brain. It does something to your mentality. It gets you dialed in. I'm in a board meeting for all of my entities every year. I should be talking about this with my family. I should be getting involved in my tax strategy and tax plan, not just dropping it off, hoping it's done right. That's not the way it's done. You'd go to a party with rich people. Oh man, half the conversations, they're talking about their tax strategy. Oh, I just bought this yacht and I'm writing it off over here. And I bought this jet and I'm writing this off. And I'm buying this building and I'm writing this off. That's what they talk about. It's like the ladies going to the store. Man, I went to Nordstrom. It was the half-yearly sale. I killed it. I got this write-off. It's like that. Saving money is fun. It's not complex. You can do it, people. Sorry, Dustin. That's my farewell speech.
Love it. Mark, thank you so much for being on the show. Great meeting you. And hopefully everybody's going to be able to get their lives changed and get them all buttoned up. But thanks again, man.
Thanks for having me.
And that is it for today. Go ahead and get my free real estate investing course. Text the word rental to 33777, RENTAL to 33777. You can also join my Real Estate Wealth Builders group coaching. Get all my courses. All right, guys, we'll see you in the next show. See ya.